Entering into 2022, the Federal Reserve sent a clear signal to the market that they are moving from quantitative easing to monetary tightening in a much faster pace this year. With the US unemployment rate now reached 3.9%, it gives a good support to the Fed to raise interest rates to curb the sustainably high inflation. If there is a need, the Fed will raise interest rates more times, believing that the US economy can absorb the monetary tightening. So at the beginning of a rising interest rate environment, markets are cautious on asset price in general, such as equity, Bitcoin. The 10-year Treasury bond may reach over 2% by the end of the year. But taking inflation into account, real interest rate will remain negative, meaning that the real bond yield will remain negative. The US economy is recovering. That will continue to support the performance of riskier assets, such as equities over bonds. A rotation of cyclical and value assets because they reflect the strong growth and inflationary impulses that the policymakers are dealing with. However, we believe that only further substantial interest rate increase will have a significant adverse impact on the stock market as a whole. We see the global economy is still facing more uncertainties. The epidemic could continue to be repeated, which will limit the economic growth potential of some countries. Although price pressures in most countries are expected to ease in 2022, inflation remains highly uncertain. It would affect consumption prospects. Bear in mind that once high inflation persists, the signal that interest rates will rise faster than expected will trigger market volatility.